All right, everyone. Today we're diving into mortgage-backed securities, MBS, one of the largest and most significant segments of the asset-backed securities, ABS, market. If you're familiar with asset-backed securities, you know they're a way to bundle loans, like car loans or credit card receivables, and sell them to investors. MBS, however, are exclusively backed by mortgages, making them a crucial component of the financial system and a major investment category. In this module, we're going to explore various types of MBS, including residential MBS, RMBS, which are backed by home loans, commercial MBS, CMBS, which are tied to commercial properties, and the structured securities within these categories, like mortgage pass-through securities and collateralized mortgage obligations, CMOs. By the end, you'll understand how these securities distribute risk, manage cash flows, and the unique risks they carry, particularly prepayment risk, that investors must consider. One of the defining characteristics of MBS is time tranching, a mechanism that creates tranches or layers with different maturity profiles within the security. Now, with mortgages, prepayment risk is a major consideration. Borrowers don't always pay their loans on schedule. They might pay them off faster or slower than expected. This variability introduces prepayment risk, which has two components: contraction risk and extension risk. Contraction risk occurs when borrowers repay their loans ahead of schedule, often when interest rates fall. Picture a homeowner who refinances their mortgage to lock in a lower rate. They pay off their old loan faster than expected, which means the MBS investor loses out on interest and has to reinvest at a lower rate, reducing returns. On the flip side, there's extension risk. This happens when borrowers pay back their loans more slowly than expected, typically when interest rates rise. As rates climb, refinancing becomes less attractive, so borrowers delay repayment, leading investors to hold on to their lower interest investment for longer than they'd like, which affects the value of future cash flows. In a rising rate environment, MBS with high extension risk can lose value as investors become stuck in a lower yielding investment. Managing prepayment risk is a complex part of MBS structuring. Securitizations use credit tranching to redistribute risk across different tranches, like senior subordinated structures, where senior tranches are shielded from defaults, giving investors more predictability. Another method is time tranching, which creates tranches with varying maturities to cater to investors with different time horizons. For instance, a CMBS might have bond classes with short, medium, and long maturities to appeal to a broad range of investors. Then there's sequential tranching, where payments are made to one tranche at a time until it's fully repaid, adding predictability and appealing to investors who need steady, scheduled returns. Let's zoom in on the types of loans that back MBS and why their characteristics are so important. Mortgage loans are secured by real estate, meaning that if the borrower defaults, the lender has the right to seize the property, sell it, and recover the debt. This creates a relatively secure investment, but it also comes with its own set of risks. One key measure lenders look at is the loan-to-value, LTV, ratio. LTV measures the size of the loan relative to the property's value. For example, an LTV ratio of 80% means the loan covers 80% of the property's value, leaving the borrower with 20% equity. Lower LTV ratios indicate that the borrower has more skin in the game, which is positive from a lender's perspective because it reduces the risk of default. Another metric to consider is the debt-to-income, DTI ratio, which compares a borrower's monthly debt payments to their gross monthly income. A lower DTI ratio means the borrower has a higher ability to handle and repay debt, which is reassuring for lenders. The type of mortgage also matters. Prime loans, for instance, are high-quality loans made to borrowers with strong credit, low DTIs, and significant equity. Subprime loans, on the other hand, carry more risk because they're extended to borrowers with lower credit scores, higher DTIs, and often higher LTV ratios. These distinctions play a big role in determining the risk profile of the MBS they back. Now, let's break down residential mortgage-backed securities, RMBS, into two main types: agency RMBS and non-agency RMBS. Agency RMBS are issued by government-backed entities like Fannie Mae and Freddie Mac in the US, or by government-sponsored enterprises, GSEs. Because they come with a guarantee on both interest and principal repayment, agency RMBS are considered a safer investment. These securities carry the full faith and credit of the government, meaning that if the borrower defaults, the government steps in to cover the payment. Most common are GSE guaranteed RMBS, where entities like Fannie Mae or Freddie Mac guarantee repayment in exchange for a fee, providing stability and liquidity in the housing market. In contrast, non-agency RMBS are issued by private institutions without government backing, so they don't have the same guarantees. This makes non-agency RMBS riskier, as investors are exposed to the credit worthiness of the borrowers directly. Non-agency RMBS saw a significant pullback after the 2008 financial crisis, but are starting to reemerge, particularly in the form of subordinated residential loans, such as solar ABS for home improvement financing. Investors in non-agency RMBS must carefully assess credit quality, loan-to-value ratios, and prepayment patterns since there's no government safety net. Moving on, there are several features of mortgages that influence both borrowers and lenders. One major feature is prepayment rights. Borrowers often have the right to pay more than their scheduled payments or even pay off the loan early. This creates uncertainty for lenders and investors, as it makes it difficult to predict the exact amount and timing of cash flows. Lenders sometimes impose prepayment penalties to offset these risks, especially if interest rates fall. A prepayment penalty compensates the lender for the difference between the contracted interest rate and the prevailing rate, helping manage potential losses if borrowers prepay at lower rates. Default and foreclosure are also critical considerations. If a borrower fails to make payments, the lender can foreclose on the property, take possession, and sell it to recoup losses. However, if the property's value has dropped below the loan balance, a situation often referred to as underwater, the proceeds might not fully cover the lender's losses. The type of loan, whether recourse or non-recourse, also matters here. In recourse loans, the lender can pursue the borrower's other assets to make up any shortfall after foreclosure, which is common in Europe. In non-recourse loans, typically seen in the US, the lender's claim is limited to the property itself. This structure creates an incentive for strategic default. If a borrower owes more on the mortgage than the property's worth, they may decide to walk away from the loan, knowing the lender can't pursue other assets. All right, let's talk about strategic default, an intriguing concept in the world of lending. Imagine you're a borrower with a mortgage that's underwater. That means your loan to value, like LTV ratio, is over 100%, and the home is worth less than the outstanding loan. If it's a non-recourse loan, you might be tempted to strategically default, which is fancy talk for walking away from the mortgage since the lender can't come after your other assets. However, things change with recourse loans. Here, lenders have the power to recover any shortfall by tapping into your other assets or income. This ability to pursue additional recovery often discourages borrowers from considering strategic default. A key type of RMBS is the mortgage pass-through security, where mortgage lenders pool individual mortgages together and issue securities backed by that pool. The cash flow from these mortgages passes through to investors who receive monthly payments that include both principal and interest. The amount and timing of these payments depend on the cash flows generated by the underlying mortgage pool, which can vary based on the loan structure and prepayment rates. In a pass-through structure, the mortgage is securitized, meaning it's treated as collateral for the security, creating a direct link between the mortgage pool and the investor returns. The cash flow generated by these securities goes not only to investors, but also covers servicing costs, which include expenses for collecting payments, managing records, and handling foreclosures. Issuers might also charge fees for guaranteeing the security. For investors, this means the pass-through rate, or net coupon, is slightly lower than the weighted average mortgage rate due to administrative fees. With varying loan characteristics in each mortgage pool, metrics like the weighted average coupon, WAC, and weighted average maturity, WAM, give investors a snapshot of the pool's overall interest rate and maturity profile. Now let's talk about the comparison of MBS and RMBS. Here's the lowdown on how MBS and RMBS stack up. Mortgage-Backed Securities, MBS, can include a mix of both residential and commercial mortgages. So you're looking at a pretty broad pool of assets, from family homes to massive office buildings. On the other hand, residential mortgage-backed securities, RMBS, are laser-focused on residential mortgages or pass-through securities. In short, MBS covers both worlds, residential and commercial, while RMBS sticks strictly to the residential side of things. Another important type of MBS is the Collateralized Mortgage Obligation, CMO, which pools multiple loans and redistributes cash flows across various tranches. CMOs are designed to address prepayment risk by creating securities with different risk profiles, tailored to institutional investors' needs. In a sequential pay CMO, principal payments go to one tranche at a time, providing clear repayment order. This time tranching setup gives investors options. Some tranches have shorter average lives for those who prefer faster repayment, while others have longer durations. For example, in a CMO with 3 tranches, A, B, and C, tranche A would receive principal payments first until it's paid off. Then payments would go to tranche B, and so forth. This setup allows investors to choose tranches that align with their timeline and risk preferences, while also providing protection against both extension and contraction risk. All right, everyone, let's talk about other CMO structures. And trust me, this is where things get really interesting. We've got a lineup of securities here that sound complicated, but are crucial for anyone diving into the world of mortgage-backed investing. Let's start with Z tranches. Picture this. Z tranches are like the quiet kid in class who keeps to themselves until graduation day. They defer interest payments until a specified date, at which point both principal and all that accumulated interest finally get paid out. That's why they're also called accretion bonds or accrual bonds. Here's the cool part. They help out other tranches by freeing up cash flows for distribution, making them great for tranches that need those early cash flows. But of course, there's a catch. These tranches are a bit risky, with average lives stretching beyond 20 years. Imagine waiting 2 decades for your investment to pay off. Plus, they can be a nightmare to value when market conditions change. Next up, we've got principal-only PO securities. These guys receive only the principal repayments from the mortgage pool. They're like that friend who only wants the main dish and skips the appetizers. The value of a PO is super sensitive to prepayments and interest rates. If rates drop or homeowners start paying off their mortgages faster, the value of a PO shoots up. So you can see how these become a hot commodity in a falling rate environment. Now let's flip that around and talk about interest-only IO securities. Unlike POs, IOs get only the interest payments. Think of them as the friend who's all about the appetizers and leaves before the main course. IO values drop when prepayments increase because, hey, if people pay off their mortgages early, there's less interest to collect. These securities don't even have a face or par value and are often used as a tool to shield portfolios from interest rate risk. Moving on to floating rate tranches, which have variable interest rates that adjust based on an index or some market reference. These tranches come with a cap and a floor, so you won't see extreme highs or lows, which is a nice way to keep things balanced. Then there's a quirky twist called inverse floaters. These are like the rebels of the CMO world. Their interest payments move in the opposite direction of market rates. Inverse floaters are a favorite tool for hedging interest rate risk in portfolios, especially when you're trying to get clever with your risk management. Now for the thrill seekers, we've got residual tranches. These tranches collect whatever cash flow is left over after all the other obligations are met. It's a high stakes game, suitable for investors who aren't afraid of risk and know how to hedge it. Think hedge funds and long-term institutional investors. If you're into that sort of adrenaline rush in your investments, this could be your thing. Lastly, let's talk about planned amortization class, PAC tranches. These tranches offer fixed principal payments as long as prepayment speeds stay within a set range. It's like having a guaranteed income stream, but only if the market behaves itself. PACs are usually paired with support tranches that take on all the prepayment risk, making PACs more stable and predictable. If you're looking for something that delivers steady cash flows and less volatility, PACs are the way to go. And there you have it. These CMO structures might sound complex, but understanding them gives you an edge in mortgage-backed investing. The key is to know how each one works and how it fits into different investment strategies. All right, let's break down the details on commercial mortgage-backed securities, CMBS, in a way that hits all the important points. CMBS are basically investment securities backed by pools of commercial mortgages tied to income-generating properties. These aren't just your average houses. We're talking big stuff like office buildings, industrial sites, shopping centers, hotels, and even senior care facilities. Here's the basic framework of how CMBS works. First up, the collateral. A collection of commercial loans is used as security. These loans could be for financing new property purchases or refinancing old mortgages. Next, there's the securitization part. Those mortgages are bundled up and sold to investors. The cool thing is they come in different risk levels, so investors can choose their risk and return sweet spot. Finally, cash flow from these properties is used to make payments to the CMBS investors. Now, CMBS isn't just an American thing, it's global. In the US, CMBS transactions usually have bigger pools of mortgages with fixed interest rates, while in Europe, the pools are smaller, and interest rates tend to float. CMBS and RMBS have similarities in their securitization processes, but there are two key features that set CMBS apart: call protection and balloon maturity. Call protection is there to stop early prepayments, which makes CMBS behave more like corporate bonds. This protection comes in two forms. Structurally, it can use sequential pay tranches, where senior tranches get paid first. On the individual loan level, it might involve rules like a prepayment lockout, penalties for paying early, or a defeasance, which is basically swapping the loan balance for a government security portfolio that matches cash flows. Then there's balloon maturity, where loans require a massive final payment instead of being spread out over time. If the borrower can't cough up that balloon payment, lenders might step in with a workout period to adjust loan terms, creating a type of extension risk. Speaking of risks, CMBS carries concentration risk. Unlike residential mortgage-backed securities, RMBS, which are spread out over lots of smaller loans, CMBS pools might only have a handful of large loans. If one loan defaults, it's a big deal, so investors have to dig deep into the structure, the specific loans, and even the property owners. Credit performance is crucial for CMBS. Two key ratios are used to assess this: the loan-to-value (LTV) ratio, which shows how much cushion there is before a default, and the debt service coverage ratio (DSCR), which measures whether a property can generate enough income to cover its debt payments. A higher DSCR means lower risk, and anything over 1 is generally good news, showing the property can handle its debt load. Lastly, let's do a quick comparison of CMBS and RMBS. CMBS deals with commercial mortgages like office buildings and warehouses, while RMBS focuses on residential mortgages. CMBS usually has higher credit risk because it's less diversified, lower prepayment risk, but higher extension risk, especially with those balloon payments. RMBS, meanwhile, is spread out more, but has its own set of prepayment and default risks. And that's the scoop on CMBS. In summary, both CMBS and RMBS offer unique ways for investors to gain exposure to real estate-backed securities. However, their underlying assets, risk profiles, and structuring mechanisms differ significantly. CMBS, backed by commercial properties, have unique features like call protection and balloon maturities, appealing to investors seeking stable, longer-term cash flows with some added risks. RMBS, specifically mortgage pass-through securities and CMOs, offer diversified exposure to residential mortgages with the flexibility to cater to different risk and maturity preferences. Understanding the distinctions, prepayment risks, and structuring mechanisms of each type helps investors make informed decisions in the complex world of mortgage-backed securities. All right, we've covered a lot today. From the basics of mortgage-backed securities, MBS, to the specifics of residential MBS, RMBS, commercial MBS, CMBS, and collateralized mortgage obligations, CMOs. You now have a solid grasp of the different types and structures. We dug into key risks like prepayment and extension risks and learned how tranching helps manage these, plus the importance of metrics like loan-to-value, is LTV, and debt service coverage ratio, DSCR, for evaluating credit worthiness. For CFA Level I, just keep these big ideas in mind. These concepts will definitely pop up on the exam, so understanding them well is a huge step forward. Nice work today. Stay focused, keep pushing, and let's ace that exam.